Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Tuesday, April the 15th, 2025. Let's have a quick look and see what's going on around markets. We do have the Bank of have the Bank of Canada tomorrow. So I just want to check in and see what the market's pricing for the Bank of Canada. Just because we have the CPI this morning, and sorry, let me just bring this up. So let's just see what's the market's pricing in for the Bank of Canada. As you guys can see here, the market's just pricing in about 8 basis points of cuts. The Bank of Canada has already cut a lot. If we actually just look at a chart here and look at, let's say, the effective rate, which is now about 2.7, much below where the Fed is. And as you can see, just looking at Canada, just to pull back a bit here, if we just pull all the way back, you can see that they started hiking. It's a nice little sort of a ziggurat kind of formation here. What we can see is that they started hiking, around about, so the spring of 2022, all the way up to almost about 5%. But since then, they were one of the first developed market banks to start sort of cutting. And you can see that they've cut quite significantly more so than the Fed at quite a regular pace. So the question is, will they do that tomorrow? And what we can see is that the market, as I said, is pricing in about a 30%, like a 1 in 3% a chance of that. Now, the thing is that, the data has been reasonably good lately, and they are a little bit concerned about inflation. And we had sort of the head of the Macklem talking the other day, essentially saying that, they're caught between a rock and a hard place, and they obviously understand that the economy could weaken because of the situation with the ongoing sort of trade dispute and whatnot, and the tariffs, etc. On the other hand, the mandate is to keep inflation under control. So what's going to be kind of interesting here is just to see if we look at the CPI. So we'll look at Canada. And just see what's expected coming in this morning. So we see that at 8:30 we've got 0.7, 2.7, 2.9. So it's expected the month over month to actually sort of attenuate a little bit down from 1.1 down to 0.7. And not a huge amount of difference for the other numbers. Now, keep in mind that the Bank of Canada, they do like to look at the trim and the median year over year, the core, these numbers here. So really what they'll be expecting to is to keep that in line or a little bit lower, because as you can see here, they're not horrible, but they're certainly not down towards the 2%. And so if they come in a little bit higher than expected, let's say in the threes, that could put those odds of the Bank of Canada actually sort of staying on hold much higher tomorrow. So if the Bank of Canada stays on hold tomorrow, and as I say, it's about a 30% chance of a hike, of a cut, and a 2/3% chance of just staying on hold. That could be determined, as I said, by that. So that's going to be interesting in terms of the USD CAD. And as you can see here, USD has lost a lot since the whole sort of trade war. We got up to almost 148 at a certain point, but now we're back down to quite an important level here. This has been the top of the trading range for a long time in 2023, 2024, and you see we finally had that breakout essentially at the end of last year. But we're back down now to about, what is it, 138 and a half or so. So it's just going to be interesting here to say because if you look at a lot of fair value models. I've been doing a bit of research. Most kind of analysts say that the Canadian dollars is, on a fair value basis, about 2% overvalued compared to the US dollar. And that's just sort of risk premium. So basically the US dollar is about 2% undervalued because of risk premium with all the tariff situations here. So if we do get let's say some sort of slightly weaker CPI, and let's say, for example, the Bank of Canada decides to do a bit of an insurance cut, we could see just a little bounce here in USD CAD off those levels. But again, with the USD just being so sort of weak at the moment, it's hard to see that bouncing a lot. On the other hand, if we get, a relatively, sort of hot CPI, and the Bank of Canada comes in tomorrow, remains on hold, and gives sort of a relatively neutral, no sort of guidance, no panic, we could see, I would say that we have a little bit of downside still. This could start bleeding into this trade range and maybe even head down to 137 also, until and unless the US dollar sort of stabilizes and the risk premium goes out of the US dollar a little bit. Other interesting thing which we had yesterday, and I just want to bring up a graphic here. We had Waller of the Fed coming out with a speech. We did sort of a little sort of a graphic representation. He did an interesting speech talking about sort of two possible scenarios. And it's basically saying that the average status at the moment, the current status is an average of about 25% tariffs. And he put out the sort of two different scenarios. And the first one was sort of for the worst case scenario with the large tariffs, as you see here on the left, of 25%. And he was saying that he thought that there'd be a very large inflation spike, maybe even short term up to 4 or 5%. He did say he thought that would be sort of a relatively short term kind of thing, because he said what would happen is that the growth would slow significantly, unemployment rate would rise, and we'd get a serious sort of slowdown, probably a recession, and therefore inflation would actually sort of be forced to come down just because the general economy was weakening. And if that were to be the case, he thought that the appropriate policy response from the Fed would be, kind of quite significant rate cuts. And he said he'd cut sooner and deeper. But that would sort of be like a negative scenario, like a sort of a bad news rate cut, and basically saying there that at that point the recession risk would be outweighing the inflation risk. So that's the sort of that scenario. But then the other scenario would be, let's say, if we kept the tariffs on, so smaller tariffs but constant tariffs, a constant rate of about 10%. He still thought that inflation would actually go up a little bit, might actually go up less, but it would be maybe a little bit more persistent. There'd be limited negative growth effects. Unemployment would remain, quite solid. And he was basically saying that in that point, at over time, you could be patient, but you would get some sort of rate cuts, not as dramatic as in this scenario, but some rate cuts. It might just take a little longer, maybe towards the end of the end of the year or so. And so, just the key takeaway here. Basically saying that the Fed shouldn't, in his view, sort of act just on sort of policy announcements, but actually just waiting for the economic impacts. And it's interesting, just the context of all this, because we had a Treasury Secretary Bessent yesterday. I think he's in Argentina, basically talking about the fact that he'd start doing interviews for a new Fed chair sometime probably in autumn, in the fall, sort of September, October. Because keep in mind that Jerome Powell's sort of tenure at the head of the Fed is coming to an end basically at the end of this year. And I just wonder here, because this was a relatively dovish scenario put out here by Waller. And I just wonder if Waller, this is kind of like a job interview, sort of signaling to the White House saying, hey, I quite like the idea of cutting rates. Because as you can see in both of these scenarios here, there'd be a much more aggressive scenario, rate cuts in sort of a large tariff scenario. And even if the tariffs were only to be 10%, he still sees some cuts. And so the market sort of listened to that yesterday. And what we did actually see, if we look at some charts here, especially at the front end of the US curve here. Oops, let's bring this up. If we look at, let's say, the 2-year, we can see, where is my friend, the 2-year? Not that I can find the 2-year. Here we go. So if you look at the 2-year here, this is the ZT, you can see that it had quite a nice little green candle here. So the yields went down. So the front end of the curve, quite liking that yesterday. It still has quite a lot of work to do. There's the 5-year. There's the 10-year. But basically, the market listening to Waller and sort of interpreting that the Fed was definitely, as soon as there's any sign of economic weakness, the Fed would sort of step in. And that could be more possible if the tariffs were to remain sort of consequential. Anyway, interesting one there. The other interesting news overnight, we did get some news out of China, essentially cutting deliveries or sort of halting deliveries, stopping deliveries of Boeing aircraft as ordered by Chinese airlines. So this is, I would say this is quite a significant, I don't know, symbolic step, and just saying to America, hey, we have some tools to play as well. But as you can see, the S&P, the stock indexes are not really collapsing or anything. But at this point, if we just sort of step back, not really doing super well. So if we just throw in a couple of moving averages here, you can see that we're sort of stalling out here at interesting levels, because this is where Trump started to announce the whole tariff thing. This is Wednesday, the 2nd of April, you see here. And you can see here that basically the market is finding it hard to fill in that gap. So we had, of course, the bounce on the 90-day reprieve. But I just wonder if we're getting towards a level here where this is the market saying, hey, we need to see just more stability and more good news and more trade negotiations and a lessening of tariffs. As you can see here, all of the moving averages are rolling over. We've got the 200 and the 100 rolling over. And I think certainly if we were to get up to 5,700, that would be definitely an interesting position to be shorting. Maybe even this is it here. Maybe we're waiting for retail sales tomorrow. And again, I mentioned it yesterday, but I think retail sales is a little asymmetric towards the downside, just because I think if the number is positive and a strong number, that could be written off and ignored as being, oh yeah, everyone was front running the tariffs and buying a bunch of stuff before the tariffs came in, and the real bad news is about to happen. On the other hand, if we get a weak number, of course, the market might just say, oh, the economic slowdown's already started to happen. So I just think this is why one reason why the stock market is finding it a little difficult to rally here. And as I say, to me, it does seem to be slightly asymmetrical tomorrow. The question is, will we get a bit of a pop in the next 24 hours or maybe on that number itself? So it looks to me like you're starting to look here at some of these Fibonacci's here. If you go back from the beginning of the down impulse on the 20th of February here, you can see that we're basically just retraced 50%, which is also a pretty key horizontal resistance just for the technicians out there. So this is an interesting level, maybe to take a shot at a short. Personally, as I said, I think 5,700 would be a very attractive sort of risk reward kind of proposition. We'll see if we get up there. Just in terms of other markets, I just want to look over in European bonds. We had an upgrade of the Italian debt market by, I think it was Fitch, about a week ago or so, and that's pretty good news for the Prime Minister over there, Meloni. And as you can see here, if you look at something like the Italian spread over the French spread, it's almost come back. It's only like 30 or 40 basis points. So, and you look at that historically, that's a very strong performance for the Italian bonds here. So you can see that the Italian risk premium versus France has almost collapsed to zero, which is very positive news for what Meloni is doing with the Italian situation over there. If you look also at Italy over Germany, essentially we did have just on some of the sort of the stress from last week that spread did go up, but it's actually come back down in again. And now we can see that the spread of the Italian bonds over Germany is only about 120 basis points, which historically is pretty strong. So all that to say that if you look again now, it's on the outright prices. So this is the BTPs. They look relatively sort of bid. Doing quite well. If you compare that to the French bonds also having a little bit of a comeback here. But what's actually kind of interesting to me is something like the German Bund. And what you can see here is that we had this announcement of all the infrastructure spending, the defense spending, loosening of the fiscal brake, and that this was around about this period here. So you see that the Bund here, it fell very, very dramatically from about 132 down to about 127. So we had a huge kind of sell-off there. But what's interesting is that you notice the way that it's come all the way back to that point. So essentially, I just wonder whether this is the market sort of saying to the German government, hey, this is fine, spend as much money as you want. There's no problem about issuance or sort of spending too much, or whether this is just a temporary sort of bounce just because of what was happening mainly in the US. And that sort of the larger macro forces here, we might start to see a little bit of a sell-off here in the German Bund. So actually, I was short myself on this, so that's what I'm hoping for. But it's interesting this morning as well. We had an auction, the Bobble, the 5-year, which was actually quite poorly received. And so I just wonder if this is now the market will start turning its attention back to the German the long end of the curve. And what I'm going to put up here, just hopefully this will load. Yeah, this is now the same thing, but as a yield. So this is now the yield. And again, you can see how the yield popped all the way up to about 3%, and it's come back down to these levels here. And so I think kind of interesting here. Just it wouldn't surprise me if this now at least wants to retest upwards. That would be logical. Same kind of thing here for the German 30-year. The Buxel here, you can see that we got sort of retested these lows, which is before the big infrastructure announcement. So I now think, is this sort of trend line going to hold? It's now going to sort of pop upwards, and we get sort of at least like a steepening. So the long end of the German curve will start to bear steepen a little bit as the market starts to refocus on the reality of that fiscal reflation, which is happening in Germany. Maybe not as much as in Italy and France, because we know that in terms of defense spending as well, we know that like the Spaniards and the Italians, they're a little bit less hawkish than certainly the French and the British and maybe even the Germans, and the Italians and the Spanish, as I say, are much less willing to just sort of spend hundreds and hundreds of billions of euros on defense spending. They prefer to let that heavy lifting be done by other members of the bloc, shall we say. That's kind of interesting. Again, just looking at some of the currencies here, the US dollar remains weak. just remains very, very weak, below 100 on the dollar index here, clinging to that sort of dollar index. Not a huge amount of sort of action at the moment, just a bit of sort of sideways consolidation here. Gold as well, if we just have a look at that. Just want to have a quick look here. So gold, again, just consolidating around these tops. This is a very overbought market here, and I get it. I understand that the central banks of China and everyone's buying, et cetera, et cetera. But I was just looking, if you're looking at the positioning, this is starting to get very, very overstretched, very, very overbought. It's the most crowded trade out there, just from a technical perspective and also just sort of sentiment. So let's keep an eye on that. It's difficult to short because it has been so strong. But I just wonder, if gold could have a little bit of a pause here. Something which I also just want to have a look at is just sort of some of the credit spreads here. And let's just look and look at those, if I can just bring them up. So I think I had those. Yeah. So if we just look here, let's look at the investment grade, just to keep this all in perspective. We can see here the investment grade, which had been just around about 80 basis points over the US Treasuries. And we know the US Treasuries have blown out quite a lot. You can see how in the last couple of weeks, they spiked up to about 120. This is investment grade, just coming down a little bit with the rest of the market now. But this is definitely one to be looking at. And if you look at the high yield as well, you could see that hold on, that's the credit default swaps. But that's probably going to show a similar thing. You see the credit default swaps and the high yield that also went up as well and now coming back. So definitely credit under a little bit of pressure. And my point is that if we remain at this sort of quite elevated levels, I think it's going to be difficult for the stock market to have sort of a serious kind of rally. So just keep an eye on those. The other thing as well, guys, we don't have a huge amount of data. We do have some sort of earnings. We had Goldman Sachs yesterday. We had Citigroup. Looks like they're just coming in. Fixed income sales trading. Look like that's a little bit of a beat here. Looking at Bank of America here. Looks pretty solid. So it looks as though the banks have been doing quite well. Now, what about consumer staples? Johnson & Johnson, first quarter adjusted EPS 277. Okay, that looks at first blush to be better than expected. So not too bad. One thing we do have today in the US, we do have Empire Manufacturing. Again, bit of a weird number, bit of a choppy number, but again, interesting just to see if this whole sort of sentiment of this sort of idea that the US economy is on the edge of a recession. We'll be looking for sort of more and more information about that. So I'll leave it there, guys, today. Just a pretty short one. As I say, let's have a look at Canadian CPI at 8:30, just to give a sense of where the Bank of Canada might be headed tomorrow, and the US dollar versus CAD as well. Okay, have a great day. We'll keep the conversation going soon. Thank you.